This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go! Hello, and welcome back to the fintech podcast that you've been waiting for, Fintech Takes, not Fintech Investment Advice. I am Alex Johnson, the creator of Fintech Takes, and joining me, the people's favorite guest, returning champion, the chef behind the brain food that we all count on every week, Simon Taylor. Simon, thank you for joining me.
Why has nobody thought of the chef of brain food before? That is my new job title. I am the Chef Investment Officer.
CEO, but he is the CIO, Chef Investment Officer behind Fintech Brain Food.
Or the Chief Eating Officer. You know, like that's it. You name your blog Brain Food, you're going to become a zombie. It's going to happen.
It absolutely will. So Simon, the chief chef, the head chef, the one who cooks all the delicious meals, is here. Simon, how are you?
Really well, sir. Again, look, as you can see, it's sunny in the UK. These are rare events. I'm enjoying it. I'm feeling grateful. How are you?
I am doing well. It is also sunny here in Bozeman, Montana. Not so unusual for this time of year, but we've actually managed to duck a lot of the more extreme heat and forest fires and smoke. And so it's blue skies. It's only supposed to get up into the 80-degree Fahrenheit range. And so we're happy. Everything is going well.
That's balmy for Montana, isn't it? That's crazy.
It is. Awesome. I mean, I know people in the U.S. and elsewhere who are in more warm climates will think that 80 is beautiful winter weather that you can't wait to get back to. And I feel you because I could absolutely not live where you live. But for us, this is pushing the upper boundaries of what I'm comfortable with. And I'm happy for it to stay right where it is.
Oh, man. I'm happy for you. You know, look at happy Alex. You're all happy. You're all excited. I like this. This is going to be a fun show.
It is going to be a fun show. So as a reminder for the audience, if you're new to this particular episode within the Fintech Takes catalog, this is where Simon and I will each bring a couple of fintech companies to the table. We have not told each other which fintech companies we want to share, but they're ones we want to talk about. As the title of this podcast suggests, this is not us offering investment advice. We never offer investment advice of any kind because, Simon, we probably wouldn't be very good at that.
You know, no career history as a VC, no career history as a registered broker-dealer or anything of the sort. We are just two dudes with opinions, and you should discount everything said accordingly. But people seem to like what we have to say on blogs, so maybe you learn some stuff about some fintech companies, you get a little bit inspired, and that's what gets me excited about doing this show with you. I learn something every time.
I do too. It's fun. It's actually really fun to cast around for fintech companies, both well-known and unknown, that are sort of tickling our brains at the moment. And as the people's favorite guest, as the chef behind Fintech Brain Food, I will let you go first. What company do you have for us?
The first company I am going to pick is Chorus. So Chorus allows payment facilitators, all vertical SaaS companies that offer payments, to screen for risk when they're onboarding a merchant. The platform uses a custom GPT-4 model to identify things like merchant category codes and NAIC codes using the business name and the address. It features real-time alerts such as, hey, this website's just shut down, or hey, this business just had a license suspension. That's what an alert sounds like. It goes, hey. Or at least it does.
You should be the voice of all the alerts in the world too. Hey,
yeah, that would be horrible. But look, this is the idea here is to save a ton of time on manual reviews when you're onboarding a merchant with its site review product, and it's checking out stuff. There's a bunch of stuff like when you're onboarding a merchant, you're looking for little subtle clues as a human, like is their website professional? Or is this clearly some spammer? Can I find this business? There's lots of little schleps, and some of that you can get through data, some of that you can get through an API. But what I liked about this is the classic example of a large language model doing that schlep work, that contextual stuff that humans are really, really good at, that machines were always really, really bad at because they could only do certainty. This is sort of like that, I need to search around a little bit. And that feel is something that humans do, but humans find it incredibly boring. I don't know if you've ever had to onboard merchants. Haven't found it particularly exciting when I've done it. And so this is really allowing humans to focus on what they're good at. So I think we're going to see a lot more of these use case specific fintech startups. But what I can't get to, and I'm curious from your perspective, is does every one of these use cases need to be a business? Do things like this evolve into an entire business themselves, and this is just the first thing they do? Or is this just a feature that everybody ends up adopting? I don't know where you stand on that spectrum.
Yeah, I think that's a good question. I mean, as it relates to generative AI sort of broadly, I think that's the central question I keep coming back to is everything is new right now, right? Any new use case, any new way that we can leverage this technology to add value, at the moment, it's a company. And not only is it a company, it's a company that you're going to get flooded with term sheets and offers for. It's like the best possible company to start in this moment. And so it's, I think, pretty hard to judge just based on the traction the company gets, how successful they are raising money, like all of those signals that you normally sort of count on to go, is this a business or is this a feature? Those signals we kind of can't really count on right now because everyone's mad for generative AI. And so I think if you look at it more from a first principles perspective, the thing that I would be curious to understand...
Drop in first principles. I'm here for it. Go.
You're a first principles guy. The thing I would want to know would be how far down the generative AI stack do you need to go to build a solution that can do this well, right? And so are we adding a thin layer of training and sort of customization on top of a more general generative AI model, like a open AI model? It sounds like maybe that's what they're doing at the moment.
Yeah, it's GPT-4 based. And I guess Bloomberg came out with their own model, and I think JP Morgan has their own generative AI model. And you can see where that might be better. But yeah, like surely this is a power law thing. Are you familiar with vector databases at all?
Not really, no.
So the idea of a vector database is you can start to embed a bunch of data into a vector database. Let's take the SEC rulebook, or let's take a bunch of advice and guidance on how you do marketing, or just rulebooks and compliance generally, or risk management best practices. And you stick that into a vector database, and then you combine the vector database with the OpenAI kind of APIs, and then voila, you've got a thing that looks like Chorus, you've got a compliance thing. Like, it really is relatively easy to do. I think at Sardine, we had 10 projects in a hackathon that did various things with a vector database based on our help files, based on various compliance documents. Like, you could build it so incredibly fast because those are the two bits you need. Vector database plus OpenAI, boop, you have a use case. So these businesses, the defensibility and the moat question, unless they're building their own model, I think is a very, very valid question.
Yeah, I agree with you. And it also relates to what you're putting into the vector database, right? Because if it's rule books that everyone has access to,
is that
right?
proprietary?
Yeah, it's not proprietary. I mean, like, it doesn't surprise me that OpenAI probably didn't include in its initial crawl training GPT all of those sort of compliance rule books and SEC guidance. Like, that's probably not the words you want when you're training just a general large language model, but they're also not hard to get, and someone else can add them in quickly. So I do think if you're going to add your own proprietary data on top of it, and maybe this is where someone like a Bloomberg or someone else can sort of have a different advantage because of the scale that they already have achieved, that's defensible. But yeah, I would question how defensible it is. The product itself makes a lot of sense to me. I remember a long time ago working on a project that was merchant onboarding, and we were working with a company called G2 Web Services. And they were this little company that you'd never really heard of, except they were one of the certified companies that could essentially remove liability from merchant acquirers when onboarding merchants from the network's perspective. So if you didn't want to get in trouble for bringing bad merchants on Visa's network or MasterCard's network, you could basically say, yeah, G2 looked at them and they said it was okay. And I remember sitting over the shoulder of someone at G2 one time and just watching them do what they do. And it was exactly what you described, which was a lot of drudgery. It was a lot of scrolling through websites and looking for stuff that was weird. And by the way, it was also a lot of stumbling onto really unpleasant things that these merchants were trying to sneak past the merchant acquirer, right? Stuff that would not get approved to be processing payments on Visa or MasterCard. And so like one of the things that someone at G2 told me was the level of burnout from employees was really high, right? Because not only is it
Oh, I can imagine.
very sort of rote, routine, unfun work, it also has a bit of a like unpleasant corners of the internet that you have to look through with your eyes and then go home to your wife and kids at the end of the day kind of work.
Didn't we see the same with, was it Meta, Facebook, their team that screens for, things like child exploitation? Imagine looking at the needle's foot in the haystack for that sort of thing. And no, wait, it's a picture of my kid. No, wait, it's a picture of my kid. No, wait, that's horrible. Yeah, not a fun job.
And so the idea of being able to take some of that off of the shoulders of human beings and let a machine do that, and I'm guessing this is probably the way they think about it as well, surfacing the things that reach a certain confidence threshold to human beings to sign off on and go, yep, that is correct, you nailed it, that's a bad thing, we don't want that, or nope, that's actually not a bad sign, like you kind of missed that. So the confidence level and just bringing the right stuff to the attention of the human beings, more scalable, more efficient, makes the job much more pleasant for the humans and doesn't rely on those models having to be 100% accurate or 100% certain.
I saw a great sentence in a recent piece by Andreessen Enterprise where they said, if microprocessors reduce the cost of compute by 3 to 4 orders of magnitude, and the internet reduced the cost of distribution by 3 to 4 orders of magnitude, then generative AI could reduce the cost of creation by 3 to 4 orders of magnitude. Now, it's interesting how a lot of the fintech use cases haven't focused on what we would consider creation, although it is somewhat creative to be able to spot these things. But you start to wonder, where are the creative sides in fintech? And I think that's still the unanswered questions. The creative industry, we've got people on strike because they're sort of really concerned about how quickly and how cheaply they could be put out of a job. And yet on the other side, you don't really have people in fintech very worried about being put out of a job, but how quickly could I create 10 innovative new financial products and now distribute them? So I think there's a thread to pull on there that could get kind of interesting.
I totally agree. I mean, I think that it kind of relates maybe to, if you boil an industry down to what they think their sort of core competency or secret sauce is, how close is that to what generative AI does and how scary is it to that industry? And I do think you're right. Like financial services, we don't think of creativity as probably the number one thing that's going to be kind of core to what we do and the value that we offer. And so it probably has sort of scared people in financial services less. It's probably just intrigued us more about, like, as we've been talking about, can you remove drudgery from my work? Can you do these things? But I do think you're right. I mean, maybe we just don't conceive of what we do in financial services in terms of it being a creative exercise, even though it is, right? Because as you're saying, iterating on product concepts, even something like, I've been thinking a lot about the creativity that goes into structuring a loan to a large commercial enterprise where you have to draft out like an argument and you're putting together a case that you then take to a loan committee.
Bullseye.
That's creative work in the same way that, like, the legal profession, there's a lot of creativity that goes into being a lawyer. And so maybe we just don't conceive of creativity the way that we should. And maybe we should be thinking about the impact of this stuff more broadly than we are.
Oh, yeah. Legal profession. The AlphaGo moment for law would be really, really interesting because lawyers are some of the most creative MFers I've ever met.
No, they really are. I mean, it's somewhat trite but true to say that professions like accounting, the law, and financial services tend to draw a lot of really smart, creative people who are, let's be honest, like attracted to money. And that's where they can get the most
bad at drawing
abilities. But like, you're right. I mean, really creative, smart, sort of lateral thinkers tend to populate these industries. So like how they pair up with generative AI is a question I'm super intrigued by. Should we jump to our next company?
Let's go. Let's jump. I'm hopping with you.
Well, so I got a good one to start. This company is called Grounded Technologies. And they were in the news this week, which is why I've been sort of thinking about them. They are building a marketplace for banks, particularly community banks, get access to deposits. And eventually syndicated loans and community reinvestment act loans and other types of assets. But they're starting, as you might imagine, given the environment that we're in, with deposits. And they're super interesting. Obviously, it's a startup. They're getting some backing from, I believe, BMO Harris. And it's, a pretty interesting play in the market because we already have a lot of these deposit marketplaces, right? We have IntraFi, we have Stonecastle, we have all of these networks that already exist to essentially sort of help banks. I wrote about this in my newsletter recently, kind of load balance deposits. And so if you have a large amount of uninsured deposits and you want to spread those out across other banks so that you can functionally increase the amount of deposit insurance coverage that you can offer to your very sort of wealthy customers, that's a service you can get through those networks. If you just have excess deposits that you need to get off your balance sheet, you can sell them to a different bank or you can buy them from a different bank. This is a little bit different. This is actually more of a classic, I think, what regulators would consider deposit broker, in the sense that they're actually going to be going out to various sources, investment firms, other types of organizations that are trying to find a place for their deposits to go and trying to sort of get a good home for their deposits. So this is like 401k companies, apparently like the EB5 immigrant investor program, opportunity zones, even like class action lawsuits where you have to have a big pool of money that gets distributed to plaintiffs in a lawsuit. All of these are places where deposits sit, and those deposits need to live somewhere. And so what Grounded is going to do is go out and try to source as many of those deposits as possible and then make them available through this marketplace to banks that need to essentially shore up their balance sheet. So very, very interesting. I guess the question that I have, there's sort of a short-term question and a long-term question. The short-term question I have is just how sort of successful they're going to be in doing that. One of the things I think people who don't sort of study community and regional banks for a living, which why would you, might not know, is that those sort of niche sources of deposits like 401k companies or class action lawsuits, or the other one that's really popular is homeowners association deposit accounts. Those are suddenly like the hottest commodities in banking. Like everybody wants those, and people are like in a knife fight to try to get them because they are sticky, they are relatively low risk, they're not necessarily rate seeking. So everyone is fighting for those. And I guess I'm a little curious about how Grounded is going to sort of outcompete other banks functionally and other brokers for going to get those. But I don't know, this is a pretty novel fintech startup idea to go build a new marketplace. What do you think of it?
The scrap over deposits is for real. If they can prove success, I wonder what the background of the founders is. I don't know if you have any history there.
One of them is actually a co-founder or was an early team member for the Bank Corp, I believe. So they do have some experience in banking as a service kind of world.
Yeah, so they probably have a reasonable network of people with the demand to buy those deposits. It's the bigger question is, can they source supply? And with all of these things, it's sourcing supply. I mean, if you're a lender right now, you don't have a demand problem, you have a supply problem. And so it really comes down to how much experience do you have doing this real difficult job of brokerage? And that feels a little bit like a human task. Maybe they've got some distribution edge, and I wonder what that is, because if they do have that distribution edge, I mean, goodness, you're selling candy to toddlers, they're going to snap your hand off. Everybody wants deposits right now. So yeah, it makes a ton of sense. And it's a little bit different to what I thought it was going to be, which you will see when we come on to the next company, because I was kind of thinking in the same way, right? But it's so interesting to me that stuff that was once just like that dusty backroom, like infrastructure stuff is now the next new hot startup idea. That blows my damn mind. And as you said, community banks, nobody wants it, nobody's interested. Deposit sourcing, like who's going to get excited by that? And then you go and have a banking crisis and you see interest rates shoot up and it's the biggest opportunity in the universe. So yeah, you've looked at the community banking space for a while. Do you think, though, they're ready to buy this? Do you think they're going to trust their own networks? Do you think there are adopters in the BaaS space? Like, who's the first adopter here?
Yeah, that's a good question. I mean, according to this American Banker article that I've been reading, they have institutions on their wait list ranging in size from 14 million in assets to 2 trillion in assets. So they seem to have a wide variety of companies that are interested. And I do think, particularly in this environment where everyone is just in a scrap over deposits, as you said, I do think they will have demand. Like any source of deposits will do for banks right now because they're sort of frantically trying to plug holes in their balance sheet. And I do think, I mean, I credit to the company's founders. They started the company in 2021 when deposits were plentiful. And so they clearly saw sort of where the puck was heading and have built something that now is very much in demand. So credit to them for doing that. And I do think there is a edge that they might have in sourcing some of these deposits, just in that a lot of those sort of niche sources of deposits have been sort of regional opportunities, which is to say that like community banks will go get the 401k provider that's in their own backyard geographically, or the HSA home management company that's in their own backyard, but they won't compete for them nationally. And so I wonder if there is an element here of like, we're going to compete with all community banks to source these deposits. And none of those community banks want to pay anything for those deposits. That's why they have value. So if we can increase the pricing slightly, we can outcompete a bunch of them on a national scale while they're all kind of busy just competing in their own market. So I could see a sort of theoretical edge that they would have. Doing that in practice will be sort of challenging. But I think the other question will be, obviously banking is cyclical. As these things sort of slide back around, maybe as interest rates stop going up, maybe they start to go down at some point, the deposit crunch kind of goes away. Are they able to build an enduring business that works countercyclically? And that, to me, will be a really interesting question. One of the things they sort of hinted at in the American Banker article was the idea of trying to build for community bank chief risk officers and chief financial officers almost more of like a dashboard that they could use to help like understand their balance sheet and manage their balance sheet and do sort of calculations and projections about what might happen to their balance sheet. So they might sort of try to segue into more of that game. It kind of reminds me a little bit of what you see in the fraud space, where most people start with like some specific mousetrap for catching one specific type of fraud. And then eventually they want to become an orchestration layer because everyone eventually wants to get to orchestration because that's the most sort of valuable, sticky place to be. So maybe they do end up being that dashboard or that orchestration layer for balance sheet management over time. But that long term, I think, will be an interesting question for them as well.
Yeah, the treasury team at a bank, the balance sheet management team at a bank, almost certainly is dealing with an aging set of reports that they're trying to make sense of via Microsoft Excel. And any upgrade on that, I think they'll take. And maybe these reports are batch, maybe they're 10 days old, 30 days old, they're end of months. Like, just to know that you got something going on and know where you stand as a dashboard, especially in the middle of the next crisis, whatever that might be, it's going to be super valuable.
I totally agree. All right, so you hinted at your next one being sort of maybe somewhat thematically similar. Give me your second company.
The second company is called Capstack.
Aha!
The balance sheet marketplace.
I knew that was the one. Okay, go.
So it allows banks to diversify sources of deposits to fund their balance sheet.
Sounds familiar.
In the way of SVB, community banks exposed to one particular client type. You know, you've all got a lot of tech companies and they're really flighty. They need to ensure that they don't have further deposit flight, or, and this is the slight difference, that there's always a buyer of loans.
Yeah.
So there's the other side of the balance sheet to think about, which is like, well, if I can't get enough deposits, can somebody go buy these loans off of me? So, you know, you've got one bank over here that's strong in small business lending, another one in consumer, and Capstack is really almost peer-to-peer on the bank side initially by the sounds of their website, allowing those two banks to borrow and move each other's deposits or participate in loan funding by building this marketplace. So it's like almost a networked balance sheet. You're diversifying your risk by buddying up with somebody. You know, maybe you're spiky in SMB in Omaha and somebody else is spiky in consumer and the West Coast, and you guys need to balance each other out. So that was the thinking.
Yeah.
Kind of similar to what we were talking about, but if I think about what would a tier one bank call this, they'd call it asset and liability management, ALM. And that is the treasury management team is 100 people, and they're spending all of their time tweaking the dials, looking at sources of funding. They're looking to make sure their balance sheet is being as efficient as possible, but they're also staying in risk management. They're adjusting it. They're dialing it. It's like a Formula One pit crew. They're constantly tweaking the dials. They're looking at data, and they're doing all of that in spreadsheets. That's very hard to do when you are a 100-person bank, when you're a 50-person bank, when you suddenly ended up with $1 billion in deposits because you did really well in banking as a service, but that creates a bunch of risk for you, and you have a bunch of consumers on the other side. So this marketplace, again, is interesting. I think it's a broader theme. I think we'll see more of it. And the dashboard thing, they don't mention that they're doing. But where your dashboard idea got me going was the actual benchmarking of where community banks are. That would be really, really interesting. Because frankly, from a supervisor's standpoint, all you've got is the data they give you via their reg reporting, which is as good as their ability to make a spreadsheet. Which, not all spreadsheets are made equal. Some people are very, very good at them. Some banks are very, very good. Some aren't. So this marketplace is kind of interesting. And if you look at what makes the big banks big, if you look at why banks do a ton of M&A, it's to have that diversified balance sheet. It's to be more profitable over time. This is giving community banks a diversified balance sheet and potentially allowing them to be more profitable. Which, frankly, as I look at the US from a UK perspective, where we have 4 very large banks who have historically dominated the market and had pricing power, it would be really good if the US didn't go that way, because I think a lot of the innovation you've seen in fintech comes from that brave, smaller bank that's willing to take the risk, but that shouldn't be existential because the market suddenly had a black swan event.
Yeah, no, I strongly agree with you. And I think kind of to your point, the idea of, I thought about this a lot actually, as it relates to like banking as a service and other areas, is can you become more profitable without becoming bigger? Is such an interesting question in banking, right? Because the only model that we've really ever used in the past was, if I want to become more profitable, I need to grow, which means I need to eat smaller ones and become bigger and not get eaten. And so there's just this sort of M&A feeding frenzy. And there is no sort of more, I guess, almost kind of cooperative model in banking for like, hey, you over there in Kansas, you're doing great. We're in California, we're doing great. Why don't we work together to sort of optimize what we do? And it's funny, I did a consulting project a long time ago where I talked to very small banks. And I was talking to like the chief lending officer, like the CFO. And it's exactly what you said, which is like, take all of the treasury management and asset liability people at a large bank and condense it all down into one person who also has a bunch of other hats that they wear. And that's like the chief lending officer or the chief financial officer at one of these community banks. They do all of this and they have to keep it all in their heads. And they are very sort of non-competitive in a weird way, right? Like if you're used to talking to bankers at bigger banks who are kind of cutthroat in the way they deal with competitors, you go down to a certain size community bank, they're not like that. They're like, oh yeah, this is what we do. And those guys over there, I meet with them at the conference every year and we grab a beer and he tells me about what's going on in Florida or whatever. Like they don't compete with each other that way because they're so removed. And so the idea of letting all of those banks sort of better optimize the profitability of their balance sheets without having to sort of be in this deathmatch competition, M&A feeding frenzy is definitely sort of an intriguing vision of the future. I think the other thing that you touch on that's interesting there with Capstack is you're right. Like there's not a lot of marketplaces, or I think they maybe use the term like intra-bank operating systems as like another way of thinking about it. But like there's not a lot of those systems that network banks together that cover both sides of the balance sheet, right? Normally it's either deposits or it's lending and loan syndication and loan sales and participation. So it's usually one or the other, but not both. And, that, again, is probably useful for a certain size bank where I'm just in lending. I need to think about where I put these loans or how I do that. But to a certain size bank, if you go further down the scale, their whole balance sheet is the responsibility of one person or a team of 3 people. And so having something that's unified across the balance sheet rather than breaking it apart is probably appealing to those banks. So I'll be very curious to see, according to the stuff I've read about them, they have a lot of like early interest from banks that they've talked to. I'll be curious to see which of those banks actually sort of make it into production and what size banks they are, because that'll, I think, tell you a lot about where they're aiming the product and what their value proposition is that they're honing it.
Well, and if you're an early stage company, going after banks as your design partner for your product, pre-revenue.
And pre-product, because this is, if I'm not mistaken, a company that raised money for their initial sort of round without even having put a line of code down. Like they just sort of described the concept. And
so you need good relationships to pull that off in this market, right? People buy from people, especially bankers.
Yep.
They really buy from people. You got to have that credibility and you got to get to that space. But if they do, yeah, I wonder who the buyer is. And I wonder who the first buyer is and who the long-term buyer is. Because as you were saying that, I thought about regionals. I was speaking to a C-suite executive at a regional a few months back, slap bang in the middle of the crisis. And, you know, one of the things they were saying is like, over the longer term, they're clearly solvent, but the pressure from their consultants, from onto the strategy team, onto the CEO, from their investors, from the board, is you got to do M&A. Who are you going to buddy up with? You got to do that to grow. You got to do. It's like, why? Be a great regional bank. Keep doing that, because the side product of forcing banks to M&A is like consumer harm. And sometimes the pressure from the regulator is go do M&A to shore up your balance sheet. But the flip side of that is you were happily a consumer using your bank account and you really like it. You had no problems with it. And then one day it gets taken over by somebody else and there's a bunch of new fees that you don't like. And now you got to use this app that you don't like. And there's a bunch of stuff that you got tricked into that you don't like. And that was normal for their customers. Their customers expected it. But you, as a customer of the old bank, you don't want any of this stuff. And that's the story of M&A that never gets told, is the pressures on it from the consultants to the regulators. It's the answer. Doesn't matter what the question is.
The regulatory perspective, I'd be curious for what regulators think about some of these new marketplaces that are popping up, right? Because I view it generally as a good thing that these traditional marketplaces that connect banks together are getting some competition, because IntraFi has been around a long time, sort of doing this thing on the deposit side. They've been very successful. They could use some competition. And I think the same thing is true on the loan syndication and loan participation side. Like a lot of this is either done informally through industry groups or consulting groups or whatever, kind of done manually, or it's done through these software products that are now a little bit long in the tooth and maybe don't solve for all of these problems. So having more competition there, particularly if it can make M&A not the only viable path forward, is, I would think from a regulatory perspective, as long as the balance sheets are getting strengthened or being diversified, great. I would think regulators would generally be on the side of, we actually want more banks and a healthy banking ecosystem, as long as all these balance sheets are kind of getting what they need to be solvent and healthy.
Here. All right, let's do this. Last one, hit me.
Last one. It's a small little fintech company. You've probably never heard of them. They do a bunch of stuff.
Try me.
Actually, a very wide set of products, P2P payments, merchant payment acceptance. They have a whole sort of electronic payments, digital payments acceptance business. Really cool name, actually. Kind of geeky, but I like the alliteration. PayPal. Have you heard of PayPal?
It wasn't that like X.com at one point? Like, I think
they rebranded. Yeah, exactly.
Oh, okay. Yeah. Because there's a new thing now that's X.com, right? Yeah. Sorry, I don't read the news.
No, it's kind of a whole like founder sort of fallout thing. But yeah, PayPal, I think is how you pronounce it.
PayPal. I mean, I gotta say, I think it could catch on just on the name alone. But you know, I don't know how they're going to think about distribution. They need some marketplace or something.
That's absolutely true. They're looking at one particular company that does a lot of like online sales. They think might be a big deal. No, okay. So obviously we're being facetious, but I did want to cheat a little bit and bring PayPal into the discussion simply because they have recently launched a US dollar stablecoin, PayPal USD or PYUSD, which I don't really know if I'll be able to navigate that particular acronym very well. Simon, I know, has many, many thoughts on it. So I'll just give the basics of how it works and then just would love for you to just go off, Mr. Taylor, on this, because I'm still trying to wrap my head around it, but I think it's worth spending a couple of minutes chatting. This is a stablecoin that is being held at Paxos Depository Trust. So it's being done in partnership with Paxos. It is built, I believe, on Ethereum and is compatible with other Ethereum wallets. So while you will initially buy it through PayPal and have the ability to transfer it to other PayPal users or be able to use it as a mechanism for P2P payments among PayPal users or even to check out with among PayPal merchants, although the stablecoin does get converted at the time of checkout in order to pay the merchant. It can also be held in more of a self-custody fashion in someone's own wallet that they might be using. So it's a little bit more, as you might imagine with a stablecoin, sort of open by default, a little bit more interoperable, but it's being offered by PayPal. Initially, it sounds like it's only going to be available to users in the US. I'm almost certain that will change probably relatively quickly. And it seems to me, Simon, like a lot of the value of this is actually going to be more aimed at folks outside the US who might want, for various reasons, to have something that is sort of tied to the US dollar. But you're the expert on this, not I. What are your sort of key takeaways from this launch?
Key takeaways. Timing is interesting. Why is PayPal doing this and why are they doing it now? We saw FTX collapse. We saw Voyager collapse. We saw a thing called a stablecoin, Terra Luna, collapse and go to zero. Why would they push this out? Why would they, as a publicly traded company, possibly the largest fintech or most well-known fintech, go and do this? And part of it could be just, hey, we were doing it anyway and we had to launch it for some tax write-down. I doubt it's that. I suspect it's a little bit more long-term than that. And so the thing that is worth doing first is adding a couple of definitions, right? So that not all stablecoins are created equal. When you say this stablecoin is held at the Paxos Depository Trust Corporation, which is headquartered in New York, has a bit license in New York, it's arguably one of the most regulated companies in all of financial services as a direct result. As a depository, it must hold every dollar as a US dollar in the depository in an account on your behalf. And what happens with a stablecoin is, I would like to buy $100 of stablecoins, please, Paxos. So I come along with my regular US dollars and give it to Paxos. They hold on to that in their depository, and in return, I get these magic beans known as tokens or PYUSD. But these magic beans really are magic. They have features that other dollars don't have. So regular digital dollars, like card transactions, like a Venmo transaction, they tend to ride on a rail, and that rail tends to either be owned by the card network, that rail is owned by the company that created it, so it's kind of hard to send money from Venmo and have it land in a Cash App, and making that interoperable is kind of hard, right? But any Ethereum wallet can send money, stablecoins, to any other Ethereum wallet anywhere in the world almost instantly for almost no cost. All you need is a compatible wallet. So all I need is compatible software or a compatible wallet. So think about the wallet as a really interesting metaphor for a physical wallet. If I have a physical wallet, I can put whatever I want in there. I can put a $10 bill, I can put a picture of my cat, I can put a button. I don't have to wait for Apple to support the thing. I can just put it in there.
Right.
And it turns out Ethereum is kind of the same. Anything that lives on Ethereum can go inside of an Ethereum wallet. That's where things start to get kind of interesting. That's not what PayPal's doing, but it is the long-term future for this. So the stable coins get really, really interesting when you start to think about who would want a global version of a dollar that's 24/7. I think a lot of people outside the US, number one.
Yeah.
And then number two, stable coins are programmable. So yes, I can program transactions today with the regular US dollar, but I can't do that in a really clearly open loop way. So I'll come back to that second point. But number one, who would want a global dollar? Well, imagine I work in Argentina. If I work in Argentina, one of the things I can do is go to the US. I can open up a bank account and fully KYC myself. I can get paid as an employee of an American company in US dollars, and I can go withdraw that up to $10,000. I can get on a plane, fly to Buenos Aires, and take that cash home. And that's a really good hedge if my inflation is getting really, really high. Problem is, getting all of those flights is a little bit inconvenient. The alternative is using the existing payments rails, but those existing payments rails can take up to 50% of the value once you've got done with fees and taxes and all of the issues around it. Stablecoin will land instantly and be available instantly. So what you end up with is a global digital version of cash, a global digital version of the US dollar. So that cross-border use case, I think, does become compelling, but you have to think about it as cash rather than thinking about it as cards, rather than thinking about it as e-money. It is cash that happens to be digital. But this cash that happens to be digital, unlike the digital paper note, the physical paper notes, has memory. So I can say, look, if Alex forgets to invite me to the next podcast recording, then I'm going to take that $10 I just gave him back. And I can leave that in there. The $10 will sit in your wallet right up until the moment you forget to invite me to the next podcast. And boop, the $10 comes flying back because it's automated. It's baked into the money itself. Now, that's where things start to get really, really interesting and really, really exciting, because you have programmable money that is open loop. So I don't need PayPal to program it. I don't need Venmo to PayPal it. I don't need to be in the United States to program it, but obviously to be compatible with the whole conversation about regulation. But this programmable money concept is really, really powerful. So I think they're leaning into it because for all of those reasons and many others, something like a stablecoin will inevitably emerge and something will be the future. So if I happen to be an existing large market incumbent and I see this coming, I need to make sure that my 78 million Venmo users, my 200 million monthly actives, want to use me first.
Yeah.
I want to use my brand power, because otherwise this could massively disrupt me. That's why I think they've done it. And I think for their users initially, it's like, hey, I have some stable coins. Why not use PayPal? I think that's what problem it solves. But longer term, it could be others.
Well, that was a tremendous explanation, and it does definitely make sense to me. Just to build on a couple of things you said, I mean, one of the things that's interesting about PayPal, and this even goes back to like the Facebook Libra days as well, although obviously that didn't work out for sort of interesting and maybe somewhat related reasons. But the idea that like one of the challenges with all of this is the money and the underlying network and the ability to move this cash around in a programmable way, that sort of already exists. The challenge is getting to all of these endpoints and putting a compatible wallet in that place. And so the idea of PayPal having solved that distribution challenge by being in however many countries around the world they're in now and having all of these users globally, that just by sort of default solves that sort of endpoint wallet challenge, right? And so I think one thing that is maybe a little bit, and I've been guilty of this in my immediate reaction to it as well, sort of missed in the analysis, is just by virtue of the way that Ethereum works, and by virtue of the fact that PayPal has this massive network of existing users, that already solves a huge portion of the problem that has held back other stablecoins, has held back other sort of aspiring multi-country payment rails, because those things are just sort of naturally solved by those two facts. I think that's one thing that's really important. I think another thing you said about just like different use cases in other parts of the world, cash and like the US dollar is an incredible store of value. And not every place in the world has a great store of value. And so while I've never been a huge fan of tokens that are not stable coins as a store of value because they're a little bit too volatile, that's why stable coins exist, a stable coin that is not Tether, and that actually is backed by a reserve currency that you know and can trust. And I think Paxos and a combination of Paxos and PayPal, that's about as trusted as you can get within these circles. That I think does make for a very compelling store of value in other countries. So I think that's one that you'll see that might take a US audience a bit by surprise, because we take it for granted that our native currency is a great store of value. And then the third bit that I think is interesting just from a PayPal perspective is, and this relates to kind of the economics of a Paxos or a Circle or any of these companies that provide stablecoins today, it's a really good business to just custody a lot of money safely. And even if you don't do sort of crazy exotic things with the money that you're custodying, you're just keeping it in a regular old bank account and collecting interest on that. Well, interest rates are high right now. And the idea of PayPal being able to custody a larger amount of money beyond what would sit in your PayPal account for your normal transactions that you do. That idea is really interesting. So the idea of like, yeah, I can have PayPal custodied money that's not actually in a PayPal account, but is being stored in this token that might even be in a different wallet outside of my PayPal account. But all of that sort of economic value accruing back to PayPal, that was the other thing that I think I missed when I was initially looking at this.
That's interesting. I missed that too.
It's a good one, right? It's compelling because it's just, I was thinking about, and this is again, like the challenge with judging something on day one versus on day, 900, right? Like you sort of have to wait sometimes for these things to develop. But the thing I was hung up on initially was just in the US, when it's confined solely to the US, there's probably not a huge value proposition for this for customers, right? Like the long-term value proposition globally is really big. The long-term value proposition for PayPal economically is really big. PayPal not missing the boat on how large-scale money movement infrastructure might evolve is really big. But, I don't think the value to like existing US PayPal users day one is going to be incredible. And I actually will be curious, maybe you have a perspective on this. I'll be curious to see how aggressive PayPal is in trying to steer US users to this, right? Because maybe it's just, hey, we wanted to have this in place. We're going to sort of let it develop slowly and organically. Or maybe it's going to be like the old days at PayPal where they would really aggressively steer you away from using a card and to using your linked bank account because they wanted to drive usage right away. Clearly, they have those muscles, right? Like PayPal has experience at steering customers within their network to preferred payment methods. So I'll be curious to see how much they exercise those muscles early on.
Think the word network's really interesting, right? One of the things people don't like about the card networks is the fees. They don't like those fees. But one of the things they really do like is the consumer protections and the rule book that comes with it. Now, what's most interesting about a stablecoin is you can bake the rule book into the software and you can upgrade that software over time. So PayPal could, with PYUSD, if it got enough adoption, build their own version of Visa MasterCard that's open loop. So you can actually start to compete with the card networks in some really interesting ways. Like once you understand that the programmability automates all of the stuff around the payment, that's where the insight is. It's that like, oh, wow, okay, if I can get adoption, then I can do all of this other stuff. And so, yeah, you're right. In the short term, it's just fulfilling demand. People have some stable coins. They'd rather hold it at PayPal. It's a nice way to move it around. But there are wallet wars. There is incompatibility. There's an issue. The interesting point for me is if we're all going to use Ethereum, ERC20s, if we're all going to use stablecoins, that's great. But Cash App and Square in particular are big fans of Bitcoin and its Lightning network. So we end up with the same problem all over again. So look, I am not suggesting that stablecoins will solve world hunger, that they're the answer to everything. But one of the things I do find is that having spent a decade since, it's been more than a decade actually, since I became head of crypto R&D at a bank, having worked with a lot of people in financial institutions, in regulators that have spent a long time looking at this space, I've built up a lot of context and a lot of understanding in this space where I can't unsee all of that. And it's very hard in one conversation to have the I know Kung Fu version of 10 years of context. But trust me when I say, if you do occasionally listen to me, that stablecoins feel inevitable to me. The biggest question is what is the catalyzing event for adoption by market, by use case? Because innovation always comes from the edge. It always serves somebody that's probably not you in the beginning, right? Stripe goes long tail. So what are those long tail use cases? And guess what? In those long tail use cases, they're mostly cross-border at the moment. They're mostly something to do with money flows and automating it and instant liquidity. They're things like merchants selling to US consumers who want instant liquidity. But what will be next? That's where things get really, really fun.
Yeah, absolutely. Well, I wish I could download your I know Kung Fu 10 years of crypto knowledge into my brain. So I'm still catching up, but I do think it is really interesting. And as I've absorbed the news over the last couple of days, definitely had my sort of perspective widened on it. So I find it fascinating. Before we go, Simon, could I ask you to manifest a quick fintech company that you would like to see exist and maybe does exist, but that you don't necessarily know of right now?
Yeah, maybe it does exist, but kind of where I was going with the Gen AI comment is do something creative in fintech. Don't just reduce my schlep, do something new. There was a company whose name now escapes me that was doing like a really cool personal finance assistant. They were like a life coach that had humans in the loop that was helping with questions like, can I afford to go on holiday? That's kind of nice, but hit me in the core, like hit me in the creating a new financial product, hit me in that space. And maybe it's in structured products, maybe it's in corporate loans, maybe it's in that sort of space. But if it's out there, I haven't seen it. So that's kind of what excites me.
I like that one. I will round that out with a slightly different perspective, but also sort of customer focused, which is I think someone should build a more sort of comprehensive credit worthiness evaluation engine. And I think they should build it to outcompete Credit Karma on the consumer side. So if you go to Credit Karma, really the only thing you're getting today, and I don't blame them for this, that when they started, it was a different world. The only thing you're really getting is a view into your credit score. And increasingly, your credit worthiness as a consumer is much more multifaceted. It's based on your bank account. It's based on your credit file. It's based on your payroll. It's based on your sort of rental history. It's based on just like a wider variety of different things that you've potentially been doing. And I don't think, as strictly as a consumer mechanism for understanding your leverage in going out and getting loans or getting access to credit, I don't think the credit score is a particularly good way of telling you, hey, this is what you're actually worth. Like, this is the leverage you have when you go talk to lenders. This is what you deserve. This is what you should hold out for and ask for and make sure that you get. I think someone needs to build a better version of that allows a consumer to, with their permission, plug in all of the data about them, including everything that sits outside the credit file, and then have something that gives a more sort of objective, unbiased view of this is your actual credit worthiness. And I think that could be the foundation of a large Credit Karma-like service that gets built out over time that's more compatible with the new world rather than the old world.
There's a company in the UK called Incredible. The website is getincredible.com. One, I love the design of it. But two, what's not obvious when you look at it is that what you're seeing is the front end, and it looks like open banking to aggregate all of my debts to do better PFM. But it is that, but it's also helping you build up your credit score. So it looks a little bit like NerdWallet meets Credit Karma and a mobile app for the consumer. But on the back end, it's really moving into that where NerdWallet really monetizes, which is in the refinancing side. But it's helping the consumer guide what they refinance to based on their data aggregated out of all of their accounts and everywhere else. I like your build. We don't really have common payroll APIs in the UK. We don't necessarily have those other sources of data that have become a lot more normal to have in the US. So I imagine if you put those two ideas together, you get something really compelling. I like your thinking, sir.
Yeah. No. So anyway, if anyone out there is looking for a new idea, that would be one I would love to see. Simon, thank you so much for carving out some time for this. As always, I learned a ton. I really appreciate it.
No, I learned an absolute ton. And I love that our minds were going the same way. We nearly picked the same company with a different name. That's the FinTech nerd way.
It is.
Nerd's gonna nerd.
It's just converging thoughts. Everything is happening. Deposits and asset and liability management. We covered generative AI. We covered stablecoins. I mean, we hit all of the big topics today. So we'll look forward to doing this again. Maybe we can have you come back again in the future. And until then, Simon, thanks for your time.
It's been emotional. I enjoyed it, man. Until next time.
Awesome.
Thank you for listening to this episode of FinTech Takes. Stay up to date with emerging companies and the latest FinTech trends by subscribing wherever you get your podcasts. And if you love FinTech Takes, please tell a friend.